Alrighty, so following on with how we can increase our trade frequency with high quality setups, today we're going to look at considering using middle time frame risk entries. This is basically an additional entry model that you can consider adding to your plan if you wish to do so. So obviously, I'm not going to go into this in depth now. I think you guys get the drill. If you haven't watched the previous lessons, make sure you do, as we talk about this in a lot more depth. But we're just basically trying to increase the number of valid and hopefully high probability entries in a given time period. Lots of benefits to having, a high frequency strategy versus a low frequency, which we should be aware of. Always a caveat of more trades does not equal more profit, which is why we still want to be having high quality trades. And it's that. Seems like when I put the thumbs up, that bubble comes up. This is okay. Sorry. Anyway, it's the balancing act of trying to increase the number of setups while still keeping that quality high. Typically, it's a trade-off, but we want to do what we can to increase both at the same time. We've previously looked at introducing an even lower time frame in specific scenarios. Now we're going to start looking at additional entry models that you can use in addition to what is taught in the core part of the course. So at the date of recording, the core two entry models we teach in the course is LC1 and LC2A, right? They're the two main entry models we teach and we suggest you focus on. We're now going to look at other entry models that you can consider. You don't have to use these. You can use one and only take one from this series. You can make your modifications to it. And that's what we're going to talk about as well, like at the end of each lesson, of potential ideas of how you can improve them or put different twists on them suited to your psychology and your approach, okay? So the general pros and cons with having more entries in your trade plan compared to obviously having less. Pros should help you get more entries, right? More ability, more ways to enter the market, obviously, potentially more profit. A big one is optionality. So it just gives you more options and different ways to enter the market on the same trade idea. Now, obviously that can be a pro for some people and that can be a con for others. And I talk about that in the cons by basically saying it can be overwhelming. If you have so much potential choice and ways in which you could enter the market, you might get like paralysis analysis where you don't quite know what entry model you should take and when and what you should wait for or not, and you can end up missing the move, right? So for some people it's good, for some people it's not so good. But yeah, generally what you'll find with your entry models is you can probably put them on a scale from like the least amount of confirmation, so the kind of the most aggressive, all the way up to having loads of confirmation and like the more conservative type. Generally that's kind of, what it can do. And then obviously the more high probability, the middle time frame idea and POI that you're trying to trade, like when everything's aligned, really high probable POI, strong momentum, etc., that's when you want to be more aggressive with your entry models. So you want to have those in your plan. And then when you're not so sure and you want a bit more confirmation, you have those to dip into and pull out of your toolbox, right? There's obviously practical reasons, like you might want to have some entry models in your trade plan that don't require you to kind of be stuck at your screen. We can have a bit more set and forget, things like that. Like maybe one morning you've got an appointment or a meeting or whatever it is. It can be handy just to have that optionality to know that you can potentially capitalize on a move without having to wait for your lower time frame intricate entry model to develop. And then again, more ways to scale into the market rather than just trying to catch that one initial entry from the POI. We can look at potential ways to scale in. Cons, more entries can lead to more risk. Like I said, inconsistent trading. If you don't know what entry model you're going to wait for and when, or too discretionary, you can end up just skipping setups. It can be overwhelming. And also using different entry models is probably going to be best with different management styles depending what entry you take. Some people don't like that. They just want to have very consistent, easy rules. So again, some pros are pros for some people, cons the other way around. And listen, you could have 3, 4, 5 entry models in your trade plan, but it doesn't mean they're like all your main entry models. You could just have 1 or 2 that you are focusing on like 90% of the time, but you just have these other ones that you understand, that you've tested and you know how to use, and you dip into them when the time is right. Okay, when it's a specific market scenario, or maybe just something's going on in your life at that point that makes it practical to use those other ones that are like a bit more hands-off, for instance. Or maybe you're usually a hands-off trader because you have a job and whatever else, but maybe you have, for whatever reason, you're able to be on the screen more for that week or that month, and now you can dive into your like lower time frame entries that you wouldn't normally use. Do you know what I mean? Okay. So today we, as you know, are looking at medium time frame or middle time frame, I should say, risk entries. Okay. So it's very, very simple. What you have learned so far in the course and how we trade 90% of the time is we have our middle time frame. So when I'm day trading, for me, that's the M15. If you're swing trading, that will obviously be the 1 hour chart. And we follow that for our trade ideas. And basically we trade, these blue boxes for me are the POIs that I'm looking to trade, right? That's my trade idea. Now, typically what we wait for is we wait for price to mitigate it. So obviously we get a medium time frame POI mitigation there, a mitigation there, and a mitigation there. Once price mitigates that middle time frame POI, that's when we then drop down to our lower time frame. So for me, that would be the M5 or like the M1. And we would wait for our entry models. And this is typically, probably haven't heard this in the course yet, but what we would refer to as a confirmation entry, a lower time frame confirmation entry. So we wait for our middle time frame POI mitigation, drop down to a lower time frame, and wait for that entry model for extra confirmation. So the two core lower time frame entry models you have learned in the course, again at the time of recording, is the LC2A and the LC1, and that's what this is. So this you should already be extremely comfortable with. If you're not, you've jumped ahead in the course, go back. What we are simply now looking at is when price gets to your POI, instead of waiting and going down to your low time frame to then wait for that entry model, you don't bother. You don't even look at it. You literally just set your buy order on the POI. So when price is coming down like this, you already have your buy limit order waiting, stop loss behind the POI, and what you're hoping is price will tag you in, the POI will be respected, and it will go without waiting for that lower time frame to turn in your favor. Okay, and again, when you get that shift, new POI, you just set your limit order there, you get tagged in, and we go. So that's it. What you've done so far in the lower time frames is confirmation entries, just using those lower time frame entry models within your middle time frame POI. Now we are looking at what we call a risk entry, but on the medium or middle time frame, I should say, just entering directly without waiting for that confirmation. Okay, so hopefully the entry model itself makes sense, but obviously the key part to all of this, it's not the entry model, it's deciding when and where to use them. So the rest of this lesson, we're going to talk about when you should consider using them. And then as always, there's fireworks going off now. Okay, I'm going to have to figure out how to turn these effects off on Loom. Sorry about that. Very unprofessional. Where was I? So next we're going to look at when we should use them. And then we're going to end on some potential more advanced ideas of how you can, improve the risk reward and potentially the strike rate with this approach. Okay, cool. So when should you use the middle time frame risk entry? Hopefully you've watched the previous lesson about using an additional lower time frame, and it all falls under the same bracket. So when thinking about when are you going to use an LC1, or when would you maybe use a middle time frame risk entry, or maybe when would you use an even lower time frame than you normally do, they all fall under this same bracket of what, for our strategy, is really high probable scenarios. And that's when you have the tight middle time frame range, you're trading pro middle time frame order flow, it's a high probability middle time frame POI. And obviously with risk entries, we're going to be entering on our middle time frame, so our stop losses are going to be bigger than we're normally used to. So we need to still make sure that there's suitable risk reward for where we're trying to target. Okay, so we can still use this same diagram that, again, you should be very, very familiar with. I'm not going to go in this in depth. Make sure you've watched the previous lesson on using a lower time frame, and you can see this. If you are using a Photon Trade Lab properly, you should not really need to read any of these annotations on this chart. You should all be very, very comfortable with this. The whole point of when you should consider a middle time frame risk entry, or an LC1 lower time frame entry, or an even lower time frame entry, like lower time frame asterisk as we're calling it, it's generally phase A or phase C. So pro middle time frame internal structure, or ideally order flow, and into a higher probable POI. So every time we have a green circle here and here, all right, tight order flow, that's where we want to just get involved aggressively. And again, phase A, pull back into the extreme, bang, 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 in that direction, no key opposing levels nearby, tight little ranges, only kind of one or two POIs to pick from. That's when we consider using these more aggressive entries, right? So like when price is here and it's pulling back, maybe you're someone who doesn't want to use the M1 or a lower time frame than you normally do, or maybe you don't have the time to, or you literally just have such high conviction in that POI holding, you want to get involved. And maybe the POI is small enough where if you set your limit order directly on it, right? You can still get suitable risk reward. Like imagine you want to target that POI, more than enough space to do so, right? So it makes sense. Why do I need to use a lower time frame? Because the whole point of lower time frames, like we're not trading lower time frame ideas, we're trading middle time frame ideas. So if the middle time frame is already showing me everything I need to see, and I can still get great risk reward, why do I need to bother going down to the lower time frame and risk missing the entry or not getting an entry, not getting a tag? Because as you know, sometimes price will literally just pull back on the lower time frame and then just go. It doesn't give you one of those entry models and you've missed the move when you're like, well, I didn't need to do that. I could have just entered directly on the POI. So this is great for that. It's also great for if you need to go, like I said, if you need to move away from your desk. It's something I utilize a lot. Another way to think about it is maybe you want to day trade like the London session, for example, and you want to use your lower time frames and your lower time frame entry models. It's kind of quite brain intensive and screen time intensive. But then maybe you want to trade New York, but you don't want to be as focused on your charts for whatever reason. So that's where you can then consider using either the swing strategy, so still use the LC entry models, but on a higher time frame, or maybe this is where you bring in your MTF risk entries, right? So do you see how having all of these different options that you can have within your toolbox that you all understand, but are still in line with all of the concepts we use? It's just thinking about them in slightly different ways. So it's not shiny ball syndrome and bringing in random, new confluences and completely different entry models from everywhere you can come up with. It's using the same ingredients that you all know, but just putting them together in slightly different ways, depending on the scenario. The market scenario has to be correct, and what is most suited to what you need to do from a practical standpoint, right? Whether you can be on the charts or not. But yeah, all of that to say is it's very, very important if you want to, have a high chance of success with these more aggressive approaches. And by aggressive, I mean MTF risk entries, lower time frame LC1s, and lower time frame asterisks, right? Where we're using even lower time frame than we normally do. You want to try and do it when you have those higher probable middle time frame scenarios. Tight order flow, pro medium time frame order flow, high probability POI, right? Cool, you get it. So I'm not going to spend hours on this. Let's look at kind of a quick, trade example scenario of when I would consider using middle time frame risk entries. Again, hopefully you've watched the previous video on using different lower time frames, and it's the exact same scenario, and it's a perfect scenario to use. It's the one that happened recently at the time of recording, where you can look at either using the MTF risk entry or using an even lower time frame or using LC1s. They all fall under the same bracket a lot of the time. Okay, so here, very simply, 4-hour internal structure is bullish. We're starting to pull back down to the discount into 4-hour daily demand. It's very likely we're going to get a reaction from here. Whether it's just up to this POI and then we come down or we get that big trade, it doesn't matter. What we mainly care about intraday is that there's going to be more than enough room to capitalize on that little leg there, right? High probable scenario, we want to get the M15, so our middle time frame in this case aligned. If we get that alignment from this POI, it's all systems go to at least kind of target this level, okay? So let's jump down to our middle time frame, which in this case is the M15. M15 is bearish, but we're coming into that higher probability 4-hour POI. Yes, there was a lot of momentum, but we're very, very overextended now. We have not had a significant pullback, not even an internal pullback really. I don't really count that. We're just trickling during Asia, building all of this buy-side trendline liquidity there above the Asia highs, and we're coming in. So what do we want to see? We want to see that MTF order flow shift. So we want to see the bullish chalk. Ideally, we want to see that middle time frame supply fail, so the M15 supply fail, and then it's all systems go to try and start following that, see how far we can ride that if we get that, okay? So price comes into our 4-hour POI. We get an M15 chalk, but as I covered at length in the previous lesson, the using a different lower time frame lesson, at this point, although we have the chalk and we have a freshly created demand level, this would be a very aggressive phase D long, very aggressive, okay? Because one, we have not had an M15 strong liquidation. We don't have to have one, but obviously that's going to be an additional confluence factor. But the main thing is that we haven't had an M15 supply fail. Okay? So when you want to play, just do a little mini lesson here. It's a bit of a segue, but it's important. When you want to play those counter trend pullbacks, so literally counter internal, counter swings, or phase D pullbacks, at minimum, step one, you want to wait for your medium time frame chalk. Okay? That's the first thing, because structure is at least starting to go in a direction in which you want to trade. That's the bare minimum you need to wait for. What I would also say, 90% of you should wait for 90% of the time, is wait for your MTF S&D fail too. Okay? So not just the chart, but you also want to see that nearest significant supply zone fail. So if you get the chock and price convincingly pushes up against that supply, and ideally with momentum, now you can really start to be more confident that supply is failing and demand is taking control. Okay. Obviously, the other thing would be, in the most ideal world, the next level, which you don't have to wait for, but would be nice if you see it, is that MTF strong liquidation. So obviously not necessarily in this order. The strong liquidation would come first, right? So by that I mean you would have the equals, or a fake break. We'd get that strong liquidation. Then we would get the chock. Then we would get the supply fail. Okay, and then when price is coming in, that would be your perfect to play the pullback, right? Whether that's just still a phase D trade, or whether that's a clear IBOS to make it phase C would be even better. But yeah, the point I'm trying to make here is if you always wait for strong liquidation, you'll miss a lot of those moves. But I would say if you're wondering when you should start to play the pullback, if it's not if there's not a very obvious IBOS, because the easiest thing to do is just wait for a bullish IBOS. Let me simplify. If you wait for a bullish middle time frame IBOS, longs are now phase C, right? Get involved. You've seen enough at that point. It's worth taking losses in the start of phase C. In my opinion, it's high probability. When we don't have a clear internal high to wait for to break, these are little pullbacks. They're not clear internal structure to me. So really the only way we can start to get phase C is if you wait for an IBOS like that, which is a long way away to form. So if you're wondering, okay, when can I get involved and a strong liquidation doesn't occur, that's where I'm saying wait for these two. So not just a chock, but a clear supply fail. Okay? So a little bit of a mini listener, a bit of a tangent, but it's important to cover in this scenario. So the first trade would be getting along here. Very, very aggressive phase D trade because supply has not failed. So this is where, you're getting into early. Wait for something a bit more obvious, wait for that supply to fail. I'm not saying you shouldn't or can't trade this way. I'm just trying to help you to keep your strike rate high until you're more experienced. So this POI ends up holding. Now we go. Now this is perfect. This is exactly what I'm saying. MTF chock, clear supply fail. We also have a demand mitigation. So not only have we now seen supply fail, we've also seen demand take control. It's like it's been respected. Prices pushed up. We now have a supply to demand flip, right? This is where demand's really taking control. It's a bit subtle, but if we zoom in, this POI formed through a sweep of liquidity. So even better. So now what do we have? We have, I bring up the slide, back one. We have a tight MTF range, pro MTF order flow, high probability MTF POI, because there's no other POI, it's the POI that has to hold, and we have more than enough risk reward to go to the upside here, right? So that for me is risk entry territory or aggressive entry. So you can consider using an even lower time frame like the M1. You can consider a lower time frame LC1. You can consider a medium time frame risk entry. So this would be it. Literally just set your limit here, buy limit on the order, on the zone, stop loss behind. Maybe one pip is enough. Again, you have to test this depending on the pair you trade, etc., etc. The general idea is what you get. So now price falls back in, right? Obviously, you want to front run the zone by your spreads. So you make sure that you do get tagged in. And now you're in a trade. Now, whether you just want to go for super quick targets, you just want to target the Asia high, because of course, we could just get something like this before we go. That's fine. Whether you want to target this kind of more significant, probably a 1 hour supply there, or whether you want to just keep trailing. Again, we'll talk into management. That's beyond the scope of this lesson. The point here is the entry model. Just giving you that additional way to get involved in the market, because a lot of you will have experienced in these scenarios when you get a very overextended run, corrective price action into a higher time frame key level, and then as the session opens, you start to see that order flow. You guys will have experienced it, not every day, but a lot of time when you get all of those stars aligning, price is not going to give you that full entry model within here. It's literally just going to keep running and running and running before it gets that deeper pullback. And that's where we just want to get involved. And this is a great way to do that. Okay. So there we go. Get another slight mitigation. We push up higher. So I'm just going to move this aside. Now this is where you can just be aggressive. We're literally vertically moving up. Now, some of you might be a bit worried about that POI here, and that's understandable. But when we start moving up like this, with that aggressiveness coming off the higher time frame level, with how the 4 hour is looking, right? Remember where we are with targets all the way up to here and potentially beyond. I would not now be concerned about these sorts of random little pauses in the market to the left. Those are most likely, not always, but most likely just reaction points back to demand before we push up higher. So that's where, again, you don't have to. It depends on how aggressive you want to be. You can look to keep just following these zones. So literally scale in, set your limit on that zone, stop loss behind, depending on your scaling rules. Okay, doesn't pull back, price pushes up. It is what it is. That's where you can leave the order on or cancel it. I would keep following the momentum. What do we now have? We have a supply to demand flip. Here's your next key POI. All right. There we go. whether you use any of the aggressive any of the aggressive entries in this case. I'm not going to keep listing them. You guys know the three main ones we've been talking about. But here's another risk entry. Again, depends on if the risk reward is suitable. I'm going to talk about ways at the end of this lesson and how you can use the same entry model but actually improve your risk reward. But we'll just keep it simple for now with entering on the edge of the zone, and then you're in the trade. Okay, maybe you missed that one, but you see more bullish order flow, or you aggressively want to scale in, depending on your scaling rules. Another potential opportunity here. Okay. The point I'm just saying is you can follow this tight M15 order flow. And then again, another opportunity on that one there. I would not scale in like this. I'm just pointing out the available MTF risk entries here. What you have to accept with aggressively following order flow like this is at some point you will get a liquidity shakeout before we then go again. Or like a bit of a deeper pullback, and then it will start forming that more, smoother price action. So you might get a stop out here, fine. But then when we start to go again, you can try and scale in aggressively in these opportunities. So if you keep trying to scale in at the top, you just have to accept the risk that might happen. In this scenario, it slightly sweeps that low. It gives a deeper mitigation into here. We get the sweep it needs to fill the liquidity, and then we push up higher. Okay? One other benefit, actually, just whilst it's on my mind, of taking your middle time frame entries, right, is that this was slightly high impact news. So a lot of you would probably go, right, I don't want to trade into that news because I don't want to do it on a lower time frame and get a lot more slippage. But you may be more comfortable trading into or holding through not a super, super high impact news like CPI or FOMC, but something like, PPI or... It's hard for me to say because markets move differently depending on fundamental volatility changes. But the point I'm trying to make is there are some uses which you might be comfortable trading through, and utilizing a middle time frame entry, you might feel more comfortable because you're going to have a wider stop loss than a lower time frame entry, so the slippage risk will be less. Okay, because your pip value is less because you're trading less lots. So again, another tool in your toolbox depending on a scenario that you're now allowed to dip into if it's something you resonate with. So you've got all of those opportunities. I'm not going to add up the R because it's a bit irrelevant. Depends on how you trade it and management and things like that. The point here is to think about the entry, and then the world is your oyster. And we spoke about this in the last lesson. These are the risk entries I would not advise you take. Of course, they can play out, but you're going to have a lot more pain trading this way, where you trade on old POIs to the left. Yes, it's pro swing. Yes, it's in the premium. Yes, it's in 4-hour supply. But what are you trading against? You're trading against that hard time frame mitigation on the 4-hour chart, right? That suggests what? Suggests potentially this larger pullback may be over and ready to go. So that's one reason why I wouldn't want to short straight away against that. Other reason is this is an old zone to the left. What's one of the main rules we say with the aggressive entries is we want to be following the immediate order flow with tight ranges. That's not a tight range from where the POI was created. From where the POI was created, these two red lines is your range. That's a big range, right? When you're getting long here from where the POI is created, it's between those two red lines, right? That's your range. It's a small, tight range. It's the immediate order flow. I don't know why I'm doing this, but hopefully that gesticulates what I mean. It's just like tight and right in front of your face. Okay. Yeah, so the other more technical reason as well, liquidity standpoint, no lid, didn't sweep. Where's the available liquidity? Nothing has been built to the right. Available liquidity is behind the POI itself. So wait for a strong liquidation and trade in line with order flow, middle time frame order flow, and in line with those tight ranges. So don't take those sorts of risk entries. They can play out, but in my opinion, this is the more hyperable way to do it. As we saw, that high gets swept. Don't just, what do we need? We want order flow to shift. So I need at least that chalk. We don't get it. We move up again. We get it here. And then that would be an aggressive way to get involved, right? So you're basically playing the sweep of that high, chalk there, and you've got an entry here. But it's well outside the session hours at this point. So it's not something I'd be looking at. But, if that sort of price action happened during session, what do you now have? You now have an ability to just set your entry order literally on here. Bang, and then you're in. All right, maybe you want to assign it to the inside bar, even better. So hopefully you guys get the drill. Very comfortable with this from the previous lesson, hopefully. It's just another way to think about the exact same market scenario. But you can just choose what to do depending on the scenario, depending on your psychology, and depending on what you're doing that day. If you need to leave the office, like for instance, at this point here, so when the 9:40, so it'd be 10 a.m., price is up here and you've got this POI, that's where you go, right, I've got to step away, I want to make some lunch, I've got a meeting, whatever it is, set your limit order. So from 10 a.m., you'll get triggered in around an hour later. And then if you've got to set and forget management, a few hours later you're out. So from 10 a.m. you can just set the order and leave it. Like that's the beauty of this. Obviously, as price starts trending up, if you weren't tagged in and starts doing this, then you want to cancel the order, right? And follow the order flow. But there we go. Alrighty, so let's wrap things up with a few potential ideas for you to test. Now, these are kind of just unnecessary, like you don't need them. The first one we're going to look at is something you can definitely consider. It's a very easy refinement and it's very mechanical and actually will help instantly improve your risk reward. The rest of them are I'm not a big fan of them, but I'll discuss them and then it's up to you to see how you think about them. But I really don't think they're that necessary. It's kind of overcomplicating things a little bit, in my opinion. So if you do like them, obviously take them, test them, or just use it as just inspiration to help you think a little bit creatively and outside the box. You'll see what I mean. But let's talk about the first one. And that is just basically slightly refining where you place that middle time frame risk entry. Okay, I'll show you. So this is a very, very simple and mechanical way to instantly improve your risk reward and consistently with these MTF risk entries. And it's simply where you place your limit order on the MTF POI. So what we've been looking at is the first approach where you literally just place it on the edge of the zone. Pretty self-explanatory, just put it on the edge, always stop us behind with whatever buffer you use, consistent. That way is going to massively increase the probability of you being tagged into a position, right? Refine it to the pivot, enter on a trade. If you want to improve your risk reward a little bit, one mechanical way you can do it is enter on the 25% of that zone. Okay, so you draw the zone, you can draw it with like a Fibonacci tool. So I'll show you the settings. Just make sure you've got 0, 1, and 0.25 ticked. So all that means is you enter on 25% within the zone. Hopefully it's self-explanatory. So just a little bit of an easier way to improve your risk reward by a decent amount. Same thing, EQ, just enter on the 50% of the zone. Just use a Fibonacci tool again. Play around with settings, just have 0.5 instead of 0.25. Hopefully that makes sense. And then the other kind of mechanical way to do it is placing your order on where the candle has closed, right? So the body of the candle. That's one way of doing it too. There's no perfect way. They all have pros and cons. The more refined you are, the higher the risk reward, but you're increasing the probability that you're not going to get tagged into the trade the more refined you are. So what I would say is if you're going to use this approach, always start off with this, the first approach. And then if you want over time, maybe consider 25% of the EQ. What I do in my own trading at the time of recording when I use risk entries like this is I always default to using the edge. But if it's in a scenario where like that zone is huge because it's a really big candle, or I'm trying to play a bit of a quick move and the risk reward is kind of against me, that's when I'll just then use the 25% just to kind of improve the risk reward. But I don't like doing it too much because if I'm taking a risk entry, it's because I'm in a high probable scenario. I just want to get into the position. There is plenty of risk reward for that big move anyway. So I don't mind sacrificing a bit of risk reward because I'd rather be in the trade. But just a few mechanical ways there to think about improving your risk reward in some scenarios. Okay, so like I said, these ones are a little bit unnecessary, but we'll go through them. And the first one is another way to improve your risk reward. And rather than entering directly on the middle time frame POI that we just looked at, you can go and search within that middle time frame POI for the lower time frame POI within that. Okay, and I'll show you what I mean. So I'm really not a big fan of this, but I'll share it anyway. I just think this is unnecessary and can be quite hard. But I'll kind of show you the way in which I would approach it. So the main way we've been looking at MTF risk entries, like I said, is entering directly on the POI. Obviously, this is not the type of way I'd recommend it, just entering directly on it. I'd much rather you wait to trade pro order flow. These two are much better in my opinion. Now, what we're talking about is when price is here and it's coming down towards your MTF POI, instead of setting your limit order directly on the POI, you drop down to the lower time frame and you study the lower time frame zones right in that leg there within the POI. If that makes sense. So that's what this box is. It's where you'd have the big MTF price action, that's the leg, and then it's created like that, right? And then as price is coming back in, you look left within the MTF POI, but on a lower time frame to find those lower time frame zones nested within your MTF POI. So obviously there's going to be those zones that are just not high probability. So what you want to look for is ones that are right at the extreme, formed through a sweep of liquidity, ideally they have some lid, and it's like that way you can I definitely recommend, like in that scenario, putting your stop loss behind, and you see how you can just improve it, using technical confluence. Again, this would be kind of an even better example where like you look in and you can already see like these clear lower time frame demand chains. There's like a sweep flip, it's got lid, like that's a very clear zone. Again, you could refine it there. And again, it's only a few pips. I'd definitely recommend just putting your stop loss behind. So the whole point of that is you can use lower time frame refinement, but make sure it's like a high probable zone that's not always going to be there. And I would still not be too over tight with the stop loss. There's just no need, okay? But something to consider. The other thing I would say is try not to use really lower time frames for this. So i.e. if you're trading M15 POIs, try and do this lower time frame refinement on the M5 rather than trying to find like an M1 zone within an M15 POI. It's just a lot of the times it's not going to work very well. In some scenarios it will if you have really tight price action, but it's just going to be really, really tricky. Just trying to think if there's anything else I wanted to say. But yeah, I think that's pretty much it. So I'll kind of show you, I'll show you an example of kind of when this can make sense. So very, very quickly on the 4-hour chart, again, you should be used to this price action. We have this bullish 4-hour internal structure. We've had a little bit of a pullback, but we barely pull back. Sharp move up and a bullish side chart. So when this was happening in the market at this time, we knew it was pretty likely price could come back down to value before we see the movement. But that doesn't always happen when momentum is strong. We did have an eye chart here. Price is pulling back into this kind of rough demand zone. So there was potential we could look for a quick bullish move up, right? Bit of a tricky area, but we won't be surprised if we saw some bullish pressure coming in. We then dropped down to our middle time frame, which was the M15 in this scenario. Now, it was bullish swing structure because we had this movement here. We then had the swing pullback. The internal structure then shifted bullish. So at this point, we thought it was high probability to then go on and take out the M15 week swing high, but it failed to do so. The internal structure then started shifting bearish. Now, when that happens, that's when I start to view it as, okay, we're probably in a range now. And this is when our structural framework can be disrespected a lot more. So basically what I'm saying is when we've had the pullback, we then shift bullish on the internal structure to take out the high, but it fails to do so, and then we start coming down. That's when our frameworks can get disrespected a lot more, when strong structure actually isn't that strong. So that's another mini lesson there. And that's when I start to kind of view this as a sideways range. And what tends to happen is rather than it following that structural framework that we're used to, price starts to move from one lower time frame liquidity pool to the next, and it can get a lot trickier to trade. Now, because of that 4-hour bias we were just looking at, where price on the 4-hour chart had pulled down, and we're potentially thinking that move can occur, that's where we're on the ball for looking for where the bear traps are and looking to see if we can potentially take quick longs. So what we had here, I actually got it drawn on, but we had this large M15 POI to the left. Again, this is quite advanced, tricky price action. So if you're a bit unsure about this, don't worry, but you'll see what I mean by the entry model in a minute. And we came into this POI, we had this big sweep of sell-side liquidity, these big equal lows. Then what do we have? A straight push down, tapping into that huge pool of liquidity in this big demand zone. And what was this? This was a straight push with no lid with the Asia highs behind it. So we do not want to be shorting from here, right? Against that sweep with no lid with Asia liquidity behind. It's very likely it's a bear trap. Do we want to get long just yet? Probably not. We want to see order flow shift. We want to see supply fail. So we've got a supply failure here, but it's not super convincing yet. Ideally, we see the Asia high get taken. All right, that doesn't quite happen. Price pushes down. Okay, not sure what's happening yet. And then bang, session opens just after Frankfurt Open. Clear supply fail. Order flow is clearly shifting up. We have a flip that formed through a sweep of liquidity with the session open volume. Coming after this big sell-side liquidity sweep here within the M15 demand, potentially that 4-hour bullish alignment. And what you have is this M15 zone here. Okay. Now this is an aggressive trade. I would not call this really that high probability. So this is not the best example of what I could have shown you. But this was actually a trade one of our experienced members, Sean, took, where it's basically just looking for a quick scalp, because we can see, probably a lot of us would agree who have experience, it's pretty high probability that if we get a quick pullback into this zone, we're probably going to get at least one push up here to this POI or potentially a bit beyond. So that's not really a lot of room to work within. So does it make sense to take a risk entry here? Maybe, but then the POI is quite big, and if you're only targeting there or just past the high, the risk to reward isn't great. So what are one of the ways in which we can look at is looking for a clear lower time frame POI within that. And this is where the M5 was extremely clear. It won't always be like this, but this is a good example. What do we have? You can see that M5 sweep, all right, liquidation. It pulled up into this M5 zone. Well, that supply reacted, failed to put in a lower low, and then bang, that's where the demand stepped into the market. So now you have that M15 sweep zone refined to a very clear M5 flip within that M15, your medium time frame zone, that you can now refine down to. So you see what I mean? That's when it can make sense to do something like this. Because now you can put your stop loss just buying that low, and now that trade is turned into a 2.4, probably about 2.2, 2R with after commissions, etc. And there you go, right? That's a quick way to instantly get like a quick scalp, reasonably decent move, because basically if this order flow is going to continue, this POI has to hold. If this POI fails, then we're probably going down. So that's why it makes sense to just be in and out with these trades, and there we go, beautiful little scalp. Definitely a more advanced example because of the M15 idea, but it's a very clean entry model example of the point I'm saying how you can refine those entries. Because this is literally the range. That's the medium time frame range. Very, very tight order flow. You're just refining it to a very clear M5 flip within it. Rather than what I see some people do, and this is what I want you to avoid if it's not clear, is where you've got that M15 supply zone, right, all the way here, and then you're going in, go, right, I want to short from this zone, and you're finding like this M1 candle, you're drawing it all the way across like this, right? Because it might look good, like it might be a sweep, it mitigated, it's a bit of a supply chain, you've got equal highs lid in front of it. You can start telling yourself this is going to be that POI that's going to hold, oh, look, I can get a 2-pip stop loss or 1 pip or whatever, and then bang, I can get a million after low. And then, you just get smashed a lot of times. Why? Because you're not trading the immediate order flow, the immediate money that's in front of you, the immediate momentum. So that's definitely not what I mean by refining MTF risk entries to lower time frame. This is what I mean. Immediate order flow right in front of you from the M5 zone. Don't go super low on your time frames when you're doing this for the most part. Okay, hopefully that makes sense. Now the third point here is exactly what we were just talking about, but you don't set your limit order on the lower time frame refined zone until you have seen a fake break like form in front of you, or at least have some lid. So there needs to be some available strong liquidity in front of your refined lower time frame zone before you set the order. So let me show you on the charts what that would mean in theory. Again, this is not, it's just an idea I had that could potentially help you improve the probabilities, right? This stuff's maybe a little bit unnecessary, but it's kind of interesting to talk about. Some of you might want to dig into it. Others of you just completely ignore it, right? This is not super important. It's just to talk through some ideas that might help you think of, some other ideas that actually work for you. But what we said here is at this point, we had the M15 push up. We really liked the M15 POI. There wasn't enough risk to reward, so we refined it to the M5 POI, and then we set the limit order. So at this point, we've got our order set. What I'm now saying is instead of doing that, you only set the limit order if there is either lid here or you wait for the fake break to occur. So the minute you get that M5 bullish chock, and now there's available strong liquidity here on the M5, now you're happy to set your order, right? Because that could potentially improve the probability of this occurring. So now what you would hope is price would come in and tag you in there, right? So you only set the limit order once that has occurred. So it's basically an LC2A, but rather than waiting for like the retrace candle, you're getting in before it. Just something to consider, but not necessary whatsoever. Keep it simple when you start off. Just take the standard M15 or middle time frame risk entries. Dig into this fancy stuff later if you want to. It's really, really not necessary. And the last thing to talk about is this is where like you're not sure whether you should take an MTF risk entry or whether you should just take like the standard LC1 that we've taught in the course, right? A low time frame LC1. You're not quite sure. So what I mean by that, to go back to this trade example here, I think it was, like say when we're at this point in the market, you really like this POI that price is coming into, it's tight. This is typically where we say, yeah, LC1 is good. But you're not sure. Do I just set a limit order here, or do I wait for price to come in on the M5 or the M1, and do I take the LC1? So if you're not sure and you're struggling with that discretion and you want a mechanical rule, this is one idea. You don't have to do this, but it's just an idea of how you could make that decision-making process mechanical for you. And one suggestion is that you always would take the lower time frame LC1 if there is lid. Obviously, you need lid to be able to do it, but sometimes there isn't any lid in the leg. So if there isn't, that's when you then set the risk entry. Okay, so to say that again, you really like the trade idea. We have this POI. You're not sure whether you should take an MTF risk entry or whether you should take the lower time frame LC1. So one rule I'm suggesting, if this helps you, is you say in your plan, you will always take the lower time frame LC1. So what do you need? You need lid. So if you go down to the M5, right, now there is lid in this case, but that one's a bit aggressive, but this lid here, you would say, right, I'm going to wait for the lid, the LC1 on that lid, and then you would take it. But if there isn't any lid, and this was just a straight push, well, then the decision is made for you, and you take the MTF risk entry. Okay? I'm not saying that's a good idea. I'm just saying do you see how, like, I'm trying to help you troubleshoot. If you're like, oh, I want to do something a certain way, or I don't like that, I have that discretion, there's always a solution. Come up with a rule like that, okay? Obviously, if you always wait for the LC1, you might not get it. Price can touch this and go. So again, there's always pros and cons. Anyway, I don't want to make this into a massive video and make it unnecessarily complicated. I just thought there's a few potential ideas there to talk about at the end. The main thing I want you guys to take away from this, you should be very, very comfortable with the scenarios of when to do it, and then just keep it simple. Enter directly on the POI, and where do I have it? And just start off by always entering on the edge of the zone. Do the 25%. I think 50% can be a bit too refined. You'll miss out on a lot of trades. And go from there. So quite a simple entry model. Really, really powerful to use. David's done a ton of backtesting walkthroughs on this as well. A similar approach to this. So dive into it. Hope you took some value from that. And I'll see you next one. Cheers, guys.